As of the market close on Wednesday, November 26th, Datavault AI Inc. is trading at exactly $2.13 per share. The market is currently closed for the Thanksgiving holiday, so these figures are final until trading resumes on Friday. We saw a downward move in the last active session, with the stock shedding 8 cents to close down 3.62%. In the after-hours session, the price remained flat at $2.13 with zero movement, indicating a temporary ceasefire between the bulls and the bears. While a 3% drop might seem like standard noise for a small-cap stock, for Datavault AI, specifically at this price level, it represents a significant testing of conviction. We are hovering just above the $2 mark, a psychological fortress that, if breached, could invite a wave of technical selling. The expectation for a company named Datavault AI is almost cinematic. Investors hear the name and immediately picture a streamlined, high-margin software company that is capturing the explosive growth of artificial intelligence, perhaps similar to the early days of NVIDIA stock or Palantir stock. The narrative expectation is that this is a pure-play data sovereignty vehicle that will effortlessly ride the wave of the global AI transition, printing money by securing data for the world's largest enterprises. However, the reality is far more complex, gritty, and frankly, confusing. The reality is that Datavault AI is behaving less like a standard software company and more like a speculative conglomerate that is aggressively pivoting into cryptocurrency, mineral rights in Tanzania, and sports licensing with the World Boxing Council. The tension between the expectation of a clean AI play and the reality of a multifaceted, capital-intensive pivot is what is driving this extreme volatility. If you are holding this stock, you are not just holding a software company, you are holding a basket of high-risk bets that includes Bitcoin treasuries and African mining royalties. Let's analyze the immediate price action we just witnessed. The drop of 3.62% on November 26th came on the heels of significant volatility earlier in the week. Volume was healthy, sitting around 25 million shares, which is substantial but lower than the average volume of over 50 million. This tells us that while there was selling pressure, it wasn't a panic liquidation. It was a methodical repricing. For those of you watching this on your Fidelity mobile app or tracking the charts on SoFi Invest, you will notice that the stock has recently bounced from lows near $2.07. This $2.07 level is critical. It is the line in the sand. If the bears can push the price below that level when the market reopens, we could see a swift move down to test the $1.80 range. On the flip side, the bulls need to reclaim $2.30 to regain control of the narrative. Right now, the stock is stuck in no man's land, drifting lower as the market digests the flurry of news releases that the company has issued in November. The most jarring piece of reality that contradicts the pure software expectation is the recent financing deal with Silex Holding Company. This is not your typical Silicon Valley venture capital round. Datavault closed the second tranche of this deal, which involved Silex purchasing warrants. But here's the kicker. The transaction involved Datavault receiving approximately 1,237 Bitcoin. If you are active in Robinhood crypto trading, you understand the implications immediately. Datavault AI is now effectively a Bitcoin proxy. By holding such a significant amount of Bitcoin on the balance sheet, the stock's price action will now be tethered, at least partially, to the price of Bitcoin. If Bitcoin crashes, Datavault's balance sheet takes a hit. If Bitcoin rallies to $100,000, Datavault looks like a genius. This adds a layer of correlation that many traditional equity investors, perhaps those using Schwab Intelligent Portfolios to manage risk, might not be comfortable with. You thought you were buying an AI data company, but you inadvertently bought a crypto holding company as well. This hybrid nature is fascinating, but introduces massive volatility that has nothing to do with the core business of data management. Speaking of the core business, we need to clarify what Datavault actually does because the About Us page is a dense forest of terminology. At its heart, the company claims to monetize data assets. They use a proprietary platform to value data, almost like an appraisal for digital information, and then help companies tokenize or license that data. The recent partnership with the World Boxing Council, the WBC, is a prime example. Datavault is tasked with using its technology to capture data from boxing events, think punch stats, audience engagement, historical fight data, and turning that into a monetizable asset stream. It sounds futuristic, and frankly, it's a brilliant concept on paper. The idea that every piece of data, from a jab in a boxing ring to a geological survey in Tanzania, can be tokenized and traded, is the blue sky scenario. This is why retail investors on Robinhood stock trading forums get so excited. They see the total addressable market of all the world's data and do the math. But the execution is the hard part. Converting a partnership agreement into actual cash in the bank is a long, arduous road, and the market's skepticism is reflected in the $2.13 price tag. We must also discuss the financials, because this is where the reality hits the hardest. In the most recent quarterly report, Datavault showed a massive year-over-year revenue increase, up nearly 150% to roughly $2.9 million. On the surface, that looks incredible. Growth investors love triple-digit revenue expansion. However, if you dig deeper into the 10Q filing, possibly using the research tools available on your Interactive Brokers account, you see the cost of that revenue. The gross margins were razor-thin, sitting around 6.8%. For context, a healthy software company like Microsoft or Adobe operates with gross margins in the 70 to 80% range. Even hardware companies like Tesla stock or Apple stock maintain margins significantly higher than 6%. A 6% gross margin implies that Datavault is spending almost as much to deliver its service as it is charging for it. This is not a software margin. This is a commodity margin. It suggests that their revenue is coming from lower quality sources or low margin reselling, rather than high margin licensing of proprietary code. Until they can expand those margins, the path to profitability is mathematically impossible, regardless of how fast revenue grows. This margin pressure leads directly to the cash burn issue. The company posted a net loss of over $32 million. Compare that to the $2.9 million in revenue. They are losing $10 for every $1 they bring in. This burn rate is the sword of Damocles hanging over the stock. It explains the constant need for financing, the deals with Silex, and the complex warrant structures. They need cash to survive. This is why we see dilution. If you own shares of Datavault, you are constantly fighting against the expansion of the share count. It is like trying to fill a bucket with water while someone is drilling holes in the bottom. This is a common phase for early-stage growth companies, but in a high-interest rate environment where capital is expensive, the market has very little patience for it. This is why institutional ownership is likely low. Fund managers at Fidelity Wealth Management or Vanguard typically avoid companies with this kind of cash burn profile until the unit economics prove themselves. Now let's talk about the management's recent moves, specifically the insider activity. We saw reports of the CFO, Brett Moyer, selling shares recently. While the sale was reported to be for tax obligations related to vesting equity, the optics are never great when a top executive is selling shares while the stock is down significantly from its highs. It shakes confidence. Investors want to see insiders buying with both hands at these low levels to signal that the market is wrong. When the CFO sells, even for taxes, it reinforces the fear that perhaps the bottom isn't in yet. If you are managing your own individual brokerage account, you have to weigh this signal heavily. Insider selling is not a death sentence, but combined with high cash burn and low margins, it creates a bearish cocktail that is hard to swallow. The company also recently updated its revenue guidance for 2026, projecting a jump to $200 million. This is the expectation anchor they are throwing out to the market. They are effectively saying, ignore the current $2 million quarter. We are going to grow 100 times bigger in 2 years. This is an audacious claim. If they hit $200 million in revenue, the stock at $2.13 is ludicrously cheap. It would likely be trading in the double digits, but extraordinary claims require extraordinary evidence. The market is currently pricing in a high probability that they will miss this target. The gap between the 2.9 million reality and the 200 million expectation is the trust gap. The Silex deal, the mining deals, the WBC deal, these are the stepping stones they claim will get them there. Let's pause on the mining aspect for a moment because it is truly bizarre for an AI company. Datavault has entered agreements regarding mineral resources in Tanzania and geothermal assets. They frame this as real-world asset tokenization, using their technology to value and trade the rights to these physical commodities. It's a creative application of blockchain and AI, but it exposes the company to geopolitical risk, mining execution risk, and commodity price fluctuation. It's a far cry from the safety of a SaaS subscription model. It makes Datavault look like a venture capital fund that is publicly traded, taking wild swings at diverse industries,